Hey there, welcome to the deep dive.
Hello.
So this one is aimed squarely at you, the ACCA student, really getting stuck into financial reporting, or FR. We're grabbing your study materials today.
Yeah, digging right in.
We're going to really unpack a core area you absolutely need for the exam.
That's right. We've got the official FR syllabus and study guide, the September 25 to June 26 one, and a pretty useful visual overview for this specific chapter we're tackling.
And our mission today is to give you a proper revision session on Chapter 7. That's the one covering tangible, non-current assets.
Yeah, a big one.
Hopefully by the end of this, you'll feel, a lot more confident tackling this topic in your revision.
Absolutely. And it's worth remembering, FR really builds on what you learned in financial accounting, FA. It takes those foundations.
And applies the IFRS standards.
Exactly. Applies those core ideas, but using the specific rules from IFRS. Chapter 7 is a perfect example of that transition.
Okay, brilliant. Let's get started then. To really get a handle on Chapter 7, I think it helps to see where it fits, in the grand scheme of the FR syllabus.
Good point. The syllabus has those 5 main capabilities, doesn't it?
Yeah, like pillars. What are they again?
Okay, so you've got A, the conceptual and regulatory framework, kind of the why and the big rules.
Right.
Then B, accounting for transactions using IFRS standards. That's the how-to for specific items.
Okay.
C is analysis and interpretation, making sense of it all. D is actually preparing financial statements.
Putting it together.
And E covers employability and technology skills.
Got it. And Chapter 7, tangible, non-current assets. That sits firmly in Capability B, right?
Spot on. Capability B, accounting for transactions. So this chapter is all about applying the specific IFRS rules to record what happens with these types of assets.
Okay. And this is important, the intellectual level it's assessed at.
Yes, primarily level 2. That means application and analysis.
So it's not just about remembering definitions.
Exactly. The exam isn't likely to just ask you, define property, plant, and equipment. It's going to give you a scenario and expect you to apply the rules from IAS 16.
And analyze the results.
Precisely. You still need the level 1 knowledge, the definitions, the criteria, but the real marks are in using that knowledge. Application is key.
So practice, practice, practice with scenarios.
You've got it. And mastering this isn't just crucial for FR, it pops up again later.
Like in SBR.
Yeah, exactly. Strategic business reporting builds on this foundation, often in more complex situations, so getting it right now really helps later on.
Okay, great context. Let's dive into the meat of Chapter 7, then IAS 16. The main objective, according to the study guide,
is basically to set out the accounting treatment for these tangible, non-current assets.
and the key standard is IAS 16, property, plant, and equipment.
That's the one. It covers your buildings, machinery, vehicles, the physical stuff a business uses for more than one accounting period.
Okay, first hurdle. When does something actually get recognized as an asset on the balance sheet? What are the criteria?
Right, recognition. IAS 16 is pretty clear here. 2 main conditions. First, it has to be probable that future economic benefits tied to that item will flow to the company.
Meaning it's likely to help generate revenue or reduce costs in the future.
And second, you need to be able to measure its cost reliably.
Cost measurability and future benefits. Okay, this leads straight into that classic accounting headache, doesn't it? Capitalize or expense.
Ah, yes, the asset versus expense decision. This is absolutely critical for application marks.
So how do you draw the line? If I spend money related to a physical item, when is it part of the asset's cost versus just an expense hitting P&L?
Okay, the key question IAS 16 makes you ask is, does this spending actually enhance the asset's future economic benefits beyond what you originally expected? Or is it just maintaining it?
So improving it versus just fixing it.
Sort of. If the expenditure increases its capacity, maybe extends its useful life significantly, or improves the quality of output, and you meet those recognition criteria again,
Probable benefits, measurable cost.
then you capitalize it. Add it to the asset's cost. But if it's just, routine servicing, repairs, painting the office, things that keep it running as it was supposed to.
Then it's an expense.
Exactly.
Right.
Straight to profit or loss.
Okay, that distinction is vital. So let's say we've decided something is an asset. How do we figure out that initial value, initial measurement?
Right. Initial measurement.
Okay.
IAS 16 says measure it at cost, but cost is broader than just the sticker price.
Okay.
You need to include basically all the costs you had to incur to get that asset, not just to your premises, but into the condition needed for it to work as management intended.
So everything to get it up and running, like what specifically?
Well, obviously the purchase price, less any trade discounts, but then add directly attributable costs.
Things you wouldn't have spent otherwise.
Exactly. Things like site preparation costs, initial delivery and handling, installation, assembly costs, maybe testing costs before you use it.
Professional fees, too.
Yeah.
Architects, engineers.
Yes, those can be included if directly related. And importantly, sometimes the estimated cost of dismantling and removing the item and restoring the site at the end of its life if there's an obligation.
Ah, the decommissioning costs.
Right. And under certain rules in IAS 23, you might capitalize borrowing costs if it's a qualifying asset taking time to build. Plus, if you build it yourself, the construction costs.
What about trade-ins? Exchanging assets.
IAS 16 covers that too. If you swap an old asset for a new one, and the transaction has commercial substance, meaning the cash flows are expected to change the cost of the new asset, is usually the fair value of the asset you gave up.
Okay, that's comprehensive for initial cost. Now, fast forward. The asset's in use. What about costs we spend later on? Subsequent expenditure.
Right. So day-to-day running costs, minor repairs, routine maintenance, these generally just get expensed as incurred.
Because they're just maintaining the existing level of performance.
Exactly. They don't really enhance the future benefits beyond the original assessment.
But sometimes you spend big money later on, don't you? Like replacing a major component or doing a huge overhaul.
Yes. And this is where it gets interesting again. If that subsequent cost is for replacing a significant part, think like an engine in a plane, or it's for a major inspection or overhaul, that's actually a condition of continuing to operate the asset.
Like a regulatory requirement.
Could be. If that expenditure meets the general recognition criteria, probable future benefits flowing, cost measured reliably, then you can often capitalize it.
So you treat the replacement part almost like a new asset.
Effectively, yes. You might derecognize any remaining carrying amount of the part that was replaced, and then capitalize the cost of the new part. It comes back to that enhancement idea.
Okay, so it's that same asset versus expense logic, just applied later in the asset's life. Enhance or maintain.
That's the core principle running through it. Are you significantly boosting its capability or life, or just keeping it ticking over?
Right. Now, IAS 16 gives companies a choice, after they've first recognized the asset, how they measure it going forward. What are the models?
Two choices for the accounting policy: the cost model or the revaluation model.
The cost model sounds simpler.
It generally is. Under the cost model, you just carry the asset at its initial cost, minus all the accumulated depreciation charged so far, and minus any accumulated impairment losses.
So, historical cost adjusted downwards for usage and value drops.
Pretty much. Straightforward.
Okay. And the alternative, the revaluation model. This one feels more involved.
It definitely has more moving parts. With the revaluation model, the asset is carried at a revalued amount. That's its fair value at the date you do the revaluation.
Okay.
Less any depreciation accumulated after that revaluation date, and less any subsequent impairment losses.
And fair value. That's basically market value.
Often, yes. What it could be exchanged for between knowledgeable, willing parties in an arm's-length transaction.
Now, if a company picks the revaluation model, they can't just do it once and then stick with that value forever, can they?
No, absolutely not. A key rule is that revaluations have to be made with sufficient regularity.
What does that mean in practice? Every year?
Not necessarily. It depends. The standard says frequently enough so that the carrying amount doesn't differ materially from its fair value at the reporting date. So if the asset's fair value changes a lot,
Like property in a volatile market.
you might need to revalue it annually. If it's pretty stable, maybe every 3 or 5 years could be enough. It requires judgment.
Okay. And when you do revalue, what happens to the depreciation that's built up already?
The most common approach, the one you usually see tested, is you eliminate the accumulated depreciation against the gross carrying amount of the asset first.
So you wipe the slate clean on depreciation.
Essentially, yes. Then you adjust the net amount up or down to the new fair value.
Okay, that simplifies the carrying amount. Now, this is often the bit students find tricky, accounting for the actual change in value, the revaluation gain or loss. Where does it go in the accounts?
Right. This is crucial and frequently tested. Generally speaking, a revaluation increase the asset's gone up in value doesn't hit profit or loss directly.
Where does it go then?
It goes to other comprehensive income, OCI, and gets stored up in equity in a special reserve, usually called the revaluation surplus.
So it boosts equity, but not profit for the year.
Correct. It's seen as an unrealized gain. The asset's worth more, but you haven't sold it, so the gain isn't earned in the P&L sense yet.
But there's always an unless, isn't there?
Yes, there's an exception. If that same asset had previously suffered a revaluation decrease that was recognized in profit or loss,
Okay.
then any subsequent increase for that asset first goes back through profit or loss, but only up to the amount of the previous P&L charge. You reverse the earlier loss first.
Okay. So increases normally go to OCI, revaluation surplus, unless they're reversing a prior PL hit for the same asset.
You've got it.
What about decreases, when the revalued amount is lower than the carrying amount?
The general rule for a decrease is the opposite. It does go to profit or loss. It's treated as an expense or loss for the period.
Okay, that seems logical, reflecting a fall in value. Is there an exception here too?
Yes. If there's already a credit balance sitting in the revaluation surplus in equity specifically relating to that same asset from previous increases,
Right.
then the decrease first reduces that surplus balance via OCI. You eat into the previous unrealized gain first. Only when that surplus is completely wiped out does any further decrease hit profit or loss.
I see. So decreases usually hit PL unless there's a specific revaluation surplus for that asset in OCI to absorb it first.
Exactly. It's like that revaluation surplus acts as a buffer for that specific asset against hitting T&L on the way down, but only up to the amount of previous gains recognized in OCI.
Okay, that logic makes sense. It prevents bouncing unrealized gains through PL, but ensures losses are recognized unless offset by prior unrealized gains.
That's the idea behind it.
And after an asset's been revalued, how does depreciation work going forward?
You just carry on depreciating it, but now you base the calculation on the new revalued amount spread over its remaining useful life.
Using the same depreciation method.
Usually, unless a change is justified. And there's also an option, which sometimes comes up, to make an annual transfer from the revaluation surplus directly to retained earnings.
What does that transfer represent?
It represents the realization of part of that revaluation gain as the asset is used up. It's the difference between depreciation based on the revalued amount and depreciation based on the original cost. It's optional, but if done, it moves the realized part of the gain into distributable reserves over time.
Right, depreciation itself. I
Yeah.
can't forget that. What's the fundamental purpose again?
It's all about systematic allocation. You're spreading the depreciable amount of the asset over its estimated useful life.
And depreciable amount is cost or revalued amount less.
Less its residual value. That's the estimated amount you'd get if you sold it today, assuming it was already at the end of its useful life minus disposal costs.
And useful life and residual value, these aren't set in stone, are they?
No, absolutely not. They are accounting estimates, and that's a key point, because estimates can change. If you revise your estimate of how long an asset will last or what its scrap value might be, you don't go back and change past accounts.
It's perspective.
Exactly. You adjust the depreciation charge for the current and future periods based on the revised estimate. The depreciation method you choose straight line, reducing balance, that's also an estimate of the pattern in which you expect to consume the asset's economic benefits.
Any other key depreciation points to flag?
Yeah, a few. Depreciation starts when the asset is available for use, ready to go, not necessarily when you actually start using it.
Okay.
And remember, the land and buildings split. Land normally has an indefinite useful life, so you generally don't depreciate it. Buildings, however, do wear out or become obsolete, so they are depreciated over their specific useful lives.
What if an asset is complex, made up of different major parts, like a plane?
Good question. That's component depreciation. IAS 16 requires that if an asset has significant parts with different useful lives, you should account for each component separately.
So depreciate the engine over its life, the airframe over its life.
Exactly. If the costs can be identified and the lives are different, this gives a much more faithful representation of how the economic benefits are being consumed.
And depreciation needs calculating under both the cost model and the revaluation model.
Yes. The principle is the same. Allocate the carrying amount over the remaining useful life. The starting carrying amount is just different depending on the model chosen.
Okay, let's jump to the end of the line for the asset on the balance sheet derecognition.
Mm.
When does it come off?
Derecognition happens either when you dispose of the asset, sell it, scrap it, exchange it, or when you determine that no future economic benefits are expected from its continued use or disposal.
And then you calculate if you made a profit or loss on getting rid of it.
Precisely. You compare the carrying amount of the asset at the time of derecognition with any net disposal proceeds you receive.
Proceeds minus carrying amount equals gain or loss.
Yep. And that gain or loss hits profit or loss immediately in the period you derecognize the asset.
Now, impairment losses. The study guide mentions this is covered elsewhere, but it's linked, right?
Very much linked. Impairment is covered in detail by a separate standard, IAS 36, which is in Section B3 of the guide. But IAS 16 naturally connects to it.
How so?
Well, IAS 16 requires assets under the cost model and revalued assets to be assessed for impairment. An asset is impaired if its carrying amount exceeds its recoverable amount.
A recoverable amount is the higher of its fair value, less cost to sell, and its value in use.
That's the one. IAS 36 gives all the rules for how to calculate that, when to test for impairment, looking for indicators, how to account for the loss, and how to deal with groups of assets known as cash-generating units or CGUs.
So IAS 16 flags that impairment is a thing,
Yeah,
but IAS 36 gives the detailed rules.
exactly. IAS 16 also briefly mentions accounting for any compensation you might receive from third parties for assets that were impaired, lost, or given up.
Okay. Lastly, on the content, disclosures. What do companies have to tell users in the notes about their tangible non-current assets?
IAS 16 demands quite a lot of disclosure, broken down by class of asset like land, buildings, machinery, etc. The goal is transparency.
So users can understand the investment in the policies?
Precisely. You need to disclose the measurement bases used, cost, or revaluation, the depreciation methods used for each class, the useful lives or depreciation rates.
And how the numbers have changed during the year.
Yes, crucially, a reconciliation of the carrying amount from the beginning to the end of the period. This is often presented as a table.
The PPE movement schedule.
That's it. It shows additions, disposals, depreciation charge for the year, any impairment losses recognized or reversed, any revaluations done, impact of foreign exchange sometimes, and other movements. It's key for analysis.
What else? Anything specific for revaluation?
Oh, yes. If the revaluation model is used, there are extra disclosures. The effective date of the revaluation, whether an independent valuer was involved, the methods and assumptions used to estimate fair value, and for each revalued class, what the carrying amount would have been if they'd used the cost model.
That's useful for a comparison.
It is, and details about the revaluation surplus movements.
One more thing before we hit exam relevance. The visual overview mentioned investment properties. They sound similar, but aren't quite the same, are they?
Ah, yes, a very important distinction and definitely an area examiners like to test. Investment properties are tangible properties, land or buildings, but they are held for a different reason.
Not for use in the business.
Exactly. They're held to earn rental income or for capital appreciation or both. Not for use in producing goods or services or for admin purposes or for sale in the ordinary course of business. Those would be under IAS 16.
So if a company owns a building it rents out to others, that's likely an investment property.
Typically, yes, and they fall under a completely different standard, IAS 40, investment property.
And the accounting rules differ.
Significantly, IAS 40 allows a cost model, similar to IAS 16, but it also allows a fair value model. And under this model...
Let me guess, it's different from the IAS 16 revaluation model.
You got it. Under the IAS 40 fair value model, changes in fair value, both increases and decreases, go directly through profit or loss for the period.
Wow. Okay. Not OCI like IAS 16 revaluations.
Nope. Straight to PL. That's a massive difference in impact on reported profit, and you absolutely need to know which standard applies based on the property's use and what the accounting consequences are.
That's a really critical distinction. Thanks for clarifying.
Okay.
Okay, let's bring it all together. The burning question for everyone listening. How is this stuff actually tested in the FR exam?
Well, given how fundamental tangible assets are, expect to see IAS 16 popping up pretty much everywhere in the exam.
Section A, the objective tests.
Definitely. Those 15 two-mark questions are perfect for testing specific rules, definitions, maybe a quick calculation on depreciation or initial cost components.
Okay. And Section B, the scenario-based questions.
Absolutely fertile ground for IAS 16. You get those mini case studies, maybe about a company buying, using, revaluing, or selling an asset, followed by 5 objective questions on it.
So testing things like calculating the initial cost correctly, working out the depreciation charge, deciding if subsequent spend is capital or revenue, figuring out the gain or loss on disposal.
All prime candidates for Section B questions.
And Section C, the big constructed response questions.
Highly likely to feature here, especially in the single entity accounts preparation question, or even within group accounts adjustments. You won't escape it.
So you'll need to actually do the accounting, calculate the depreciation, record the revaluation correctly, handle disposals as part of preparing the statement of financial position or P&L.
Exactly. It's about applying the rules within that broader context.
So it's a mix of skills needed.
Definitely. You need the computational skills crunching the numbers accurately for depreciation, for the revaluation surplus movements, for disposal proceeds and gains losses. But you also need the discursive skills.
Explaining things.
Yes. You might need to explain why a certain cost should be capitalized based on the criteria, or justify the accounting treatment for a revaluation decrease, or maybe discuss the impact of changing an estimate like useful life. That's hitting the level 2 application and analysis requirement.
Okay, so really need to understand the why as well as the how.
Couldn't have said it better myself.
Right. Well, that feels like a pretty comprehensive deep dive into Chapter 7, Tangible Non-Current Assets, and IAS 16 for FR revision. We've covered recognition criteria.
Initial measurement, subsequent costs.
The big choice between the cost and revaluation models and the mechanics of revaluations.
Depreciation principles, including components.
The derecognition and calculating gains or losses.
The link to impairment under IAS 36, and the key disclosure requirements.
And that important distinction with investment properties under IAS 40.
Mastering these areas is, well, it's non-negotiable for FR success, really. It feeds into so much of preparing and understanding the financial statements.
So as you revise, the key seems to be practice. Apply the rules, work through examples.
Definitely. Do the calculations, but also pause and think, could I explain why I'm doing this? That will help with those discursive parts.
Great advice. And before we wrap up, here's that final thought for you to mull over as you continue studying.
Considering that companies can choose between the cost model and the revaluation model for their property, plant, and equipment under IAS 16, and have different rules again for investment properties under IAS 40. How might these different accounting policy choices significantly affect how an analyst or any user of the accounts interprets a company's performance, its profitability, its gearing ratios, maybe even their perception of the underlying value and risk in the business?
Something to chew on. Thanks for joining us for this deep dive.